Let me ask you something that most people never think about until it's too late. Is your money actually protected? I don't mean safe as in diversified or growing like in an investment account. I mean, if your bank or brokerage failed tomorrow, what would actually happen to your money? Would it still be there? Most people assume the answer is yes. They've heard the words FDIC insured or SIPC protected tossed around, and they think that means everything they have, checking, savings, investments, is fully covered. But that's not exactly how it works. Today, I want to break down what those protections actually mean, who qualifies for them, and where the biggest blind spots are, especially if you're married, have multiple accounts, or hold assets like crypto or gold. Let's start with the one most people know, FDIC insurance. The Federal Deposit Insurance Corporation was created during the Great Depression, after thousands of banks failed to restore trust in the banking system. If you have money in an FDIC insured bank, your deposits are protected up to $250,000 per depositor, per bank, per ownership category. Let me translate that. If you have a personal checking account at Chase with $250,000 and a savings account at Chase, the same bank, with another $250,000, together that's still only insured up to $250,000 total because they're in the same ownership category at the same bank. But if you put $250,000 at Chase and another $250,000 at Bank of America, both are individually fully insured because you're dealing with two separate FDIC member banks. Now, here's where it gets interesting. If you have a joint account, like with your spouse, each person gets their own $250,000 limit. So that same account is covered for $500,000 total. If you each also have individual accounts at that same bank, those get their own $250,000 each as well. So together, you could have $1 million insured at one institution, depending on how your accounts are structured. And that's the key phrase, how your accounts are structured. FDIC insurance doesn't care how many accounts you have, it cares how they're classified. Individual, joint, trust, business, retirement, each of those are separate categories with their own $250,000 limit. If you want to see your exact protection, FDIC has a tool online called EDIE, the Electronic Deposit Insurance Estimator. You enter your banks, account types, and balances, and it shows you exactly what's insured and what's not. This topic became very real in 2023. In just a few months, Silicon Valley Bank, Signature Bank, and First Republic Bank, which is actually my bank, they all collapsed, representing over $500 billion in combined assets. These failures were the largest since 2008. And while the FDIC stepped in to protect depositors, those who exceeded the insured limits had some nerve-wracking days before actually getting any clarity. It was a reminder that even though no one has lost insured money since 1933, plenty of people have lost uninsured money simply because they didn't understand the limits. Now, let's move to the other side of the table, your brokerage accounts. This is where the Securities Investor Protection Corporation, or the SIPC, comes into play. SIPC is not the FDIC for investing. They're two separate entities. SIPC does not protect you against market losses. It does not reimburse you if your stocks drop in value or if a mutual fund performs poorly. Now, what SIPC does protect you against is brokerage failure. If your brokerage firm, Fidelity, Charles Schwab, collapses or misplaces your securities due to fraud or insolvency. The limit here is $500,000 total per customer, including up to $250,000 in cash waiting to be reinvested. So, for example, if you had $300,000 in stocks and $200,000 in uninvested cash in a Schwab account, SIPC would cover all $500,000 if Schwab went bankrupt or your assets went missing. But If the stock market tanked, SIPC wouldn't do anything because that's just market risk. A few major brokerages, which I already mentioned, another one being TD Ameritrade, purchase excess SIPC insurance from private firms that can extend coverage into the millions of dollars. But that's voluntary, institution specific, and not government backed. So think of SIPC as bankruptcy protection, not investment insurance. It exists to make sure you get your money and securities back if the brokerage itself fails, not if your portfolio loses value. Here's another misconception. People think that having multiple accounts increases protection automatically. It doesn't. FDIC and SIPC both calculate insurance based on ownership type, as mentioned before, not the number of accounts. So if you open 5 checking accounts in your own name at Wells Fargo, you're still only insured for a combined total of $250,000. But if you open one in your name, one joint with your spouse, and one under your business entity, each of those has its own $250,000 limit. For married couples, this means you can multiply your protection by being strategic with ownership, and then also looking at separate institutions. For example, a joint account with $500,000, that's covered up to $250,000 each per person in the partnership. Individual accounts of $250,000 each, covered. Business account of $250,000, covered. That's a total of $1.25 million insured at the same bank just by structuring ownership types correctly. For high net worth individuals or anyone with large cash balances, this strategy, combined with spreading deposits across multiple institutions, provides full protection without sacrificing liquidity. Now, let's talk about what isn't protected, because this is where most people get burned. Neither FDIC nor SIPC cover crypto, precious metals, or collectibles at the time of making this video. Let's start with crypto. Even if your exchange or app says it's FDIC insured, that usually applies only to the cash balance in your account, not your Bitcoin or Ethereum holdings. When FTX collapsed, billions of dollars in user assets disappeared. Billions. FDIC did not step in because crypto is not a deposit. It's an investment product and it's unregulated by FDIC standards. The same thing goes for gold and precious metals. And I know gold is very hot right now. If you buy bullion, gold bullion, coins, or even store physical gold through a third-party service, it's not FDIC or SIPC protected. SIPC only covers registered securities like stocks, bonds, mutual funds, and ETFs. Physical commodities are excluded. And this one surprises a lot of people. Money market funds, the kind held inside a brokerage, are not FDIC insured. They're investments, not deposits, and their value can fluctuate. Only money market deposit accounts held at a bank fall under FDIC coverage. A quick word about fintech apps, because this is where the line gets even blurrier. Companies like Chime, SoFi, Cash App, and Robinhood partner with FDIC insured banks. That means your deposits may be insured, but the company itself isn't the bank. It's just a front-end interface, the user experience. So you need to check which bank actually holds your funds. That information is usually buried in the fine print of the app's terms or the FAQs. If it's not clear, that's a red flag. Here's how to check your coverage right now. Number 1, go to fdic.gov/EDIE. It's their online insurance calculator. Enter your accounts, ownership types, and banks, and it'll tell you exactly how much is insured. Number 2, look up your bank's FDIC certificate number. It's public. Number 3, visit sipc.org and confirm whether your brokerage is a member. Number 4, if you hold large balances, Ask your bank about ICS, which is the Insured Cash Sweep, or the CDARS programs. These automatically distribute your deposits across multiple banks to keep every dollar insured, even into the millions. So here's the reality. FDIC protects your cash deposits, checking, savings, CDs, and certain money market deposit accounts, up to $250,000 per depositor, per bank, per ownership type. SIPC protects your investments, but only if the brokerage fails, and only up to $500,000 per customer. And crypto, gold, and collectibles, those are completely unprotected. The best way to protect yourself isn't just diversification, it's account structuring. Spread your money across ownership categories and institutions. Don't assume that your bank or app will do it for you. And if you've never checked your coverage, do it today. Because financial stability isn't about how much you earn, it's about how much you can keep and keep safe when the system around you shakes. If you want a simple one-page checklist that walks through exactly how to structure your accounts for maximum protection, especially for married couples, trusts, and businesses, comment FDIC below and I'll send it to you. Because if we spend our lives working for money, we should at least make sure our money is working for us and staying protected while it does.